You won't believe what just rattled the silver and copper markets. President Trump has started a 180-day countdown that could bring in a baseline pricing model for key minerals. Yes, including silver and copper. It begins with diplomatic talks but ends with direct controls if needed. And if those talks fall apart, the government can legally step in and change the price model you see on your screen. That's the spark. That's the shift. And in the next few minutes, you'll understand why this is much deeper than a single newsflash, why the first price move might be the tiniest, and why the real impact could land on day 179, when most people still think they have time. Here's why you need to stick around. The headlines will obsess over tariffs that don't even exist yet, while the true hammer is a quiet minimum price policy hiding in plain sight. I'll walk you through how that tool can trigger a scramble to buy early, why even a successful deal could boost prices, and the one market signal that shows when smart money starts loading up. Miss that signal, and you'll arrive late and pay a premium. Before we go further, quick request. I'm fighting back against clone channels that steal my original work and re-upload it. If you support real content, hit subscribe and drop OG John AG in the comments. One last thing, if you want real-time updates, rapid-fire posts, personal opinions, voice notes, and alerts I don't put on YouTube, I've created a WhatsApp broadcast. Links in the description, join it. Because when the market moves, timing beats opinions. Now, let's break down what this proclamation actually means, minus the noise. Because this policy isn't aimed at a single metal, it's aimed at a basket. Minerals that power energy storage, military tech, grid infrastructure, electronics, and the next era of global industry. Lithium, nickel, cobalt, rare earths. And then the two names that send a jolt through the charts, silver and copper. Here's the catch. It's not starting with tariffs. It starts with price floors, set through agreements with U.S. partners. In short, a shared minimum import price to stop what they call dumping and to stabilize sourcing. It sounds bureaucratic, but it's not. Price floors aren't paperwork. Price floors are power. A tariff adds cost. A floor says this product is not allowed below this number, period. And when you enforce that across borders, you don't just tweak trade. You alter the whole structure of incentives for suppliers, refiners, and buyers. Watch this next part closely. There are no tariffs yet. That matters. This isn't a sudden 25% slapped on everything moment. They've started a clock, 180 days to negotiate, align, and prepare. Then, if diplomacy fails, the minimum price floor and Section 232 powers are right there, ready to go. And Section 232 is not a light switch. It's a hammer. It's a national security law with teeth. It's the kind of tool that reshapes entire sectors, which is why smart traders don't wait for day 180. They start gaming the outcome today. Some of you might wonder, why 180 days? Here's why. It's long enough to look fair, but short enough to trigger urgency. It fits buying cycles. It fits election timelines. It fits the rhythm of global deals. And most of all, it fits market psychology, because 6 months is just enough time for major players to quietly shift their positions. Here's what that looks like for you. Month 1 brings confusion and noise. Month 2 and 3 bring press leaks, spin, and false hope. People get comfortable. Month 4 and 5 bring pressure. Talks get tense. Deadlines approach. And behind the scenes, major buyers begin to act, but quietly. They don't want to be seen chasing. Then comes month 6, and regular people finally ask, so, now what? But by then, the institutions have already made their bet. If you're treating this like a one-day headline, you're already behind. Now let's simplify price floors. Imagine the government declares, no imported silver or copper product can enter below X price. That means the lowest cost supply vanishes overnight. Not because the metal is gone, but because the rules just changed. And when the bottom tier disappears, the competition jumps to the next cheapest tier. That's how price floors lift the curve, even with no extra demand. But it doesn't stop there. Floors need enforcement. You need a trusted benchmark price. You need clear paperwork. You need audits. You need punishments for cheating. And you need anti-evasion rules to stop people from mislabeling goods. So a price floor isn't just a number. It's an entire system. And systems create winners. If you're in the preferred circle, trusted, verified, and inside the network, you get a tailwind. If you're not, you hit a wall. Now here's the emotional trap. One camp will say, this is economic manipulation and unfair restriction. The other camp will say, this is about national security and independence. Both views can be true, but while they argue, only one group wins, the ones who moved early and stayed ahead of risk. That's why I keep saying, the goal isn't to predict perfectly, it's to be prepared. Now let's revisit Section 232. Most people hear that and shrug, but it's the clause that makes trade a security issue. And once it's labeled security, it jumps up the priority list. It opens the door to quotas, to bans, to selective exemptions, to punishing specific product forms, to fast-moving decisions that benefit allies and isolate everyone else. And when negotiations go public and ugly, Section 232 doesn't wait. That countdown is also a test of resolve. If leaders promise to end reliance and fail to act, it's weakness. If they act decisively, it's strength. And when the spotlight's this bright, guess which path they usually pick. Now here's a fourth curveball almost nobody sees coming. Even if the talks go well, prices can still rise. Because success could still include base pricing rules. It could still require anti-dumping pledges. It could still push for shared stockpiles and soft limits that behave like hard caps. So don't assume a deal means cheap metals. A deal could validate the floor. Now let's move through 3 scenarios fast. Drop a comment with the one you think plays out. First, the clean deal. Allies align. Minimum prices are approved quietly. Supply stays steady but at a firmer price level. Swings calm down. Everyone claims it was obvious. This is the grown-up outcome. Second, the bumpy deal. Talks drag out. Media flips daily. Markets whipsaw. A last-minute fix emerges, full of fine print, odd clauses, and backdoors. Price action stays messy because no one trusts it. This is crisis averted, but barely. Third, the breakdown. Talks fail. Price floors activate. Restrictions hit. Retaliation chatter spikes. Buyers race to secure inputs. Producers become national assets. Prices reprice violently. This is the fire alarm scenario. Now here's the unnerving part. Even if you think the clean outcome is likely, the market may still price in the worst-case path because the risk exists. So, managing risk becomes the key. Now, let's pull this back down to earth. What should you actually be watching over the next 180 days? Look out for joint reserve announcements. Look for language around vetted processing and trusted chains. Look for new capital programs, loan support, expedited permits, and bilateral deals. Look for purchasing shifts tied to defense and infrastructure. Watch for foreign export policy pivots. And watch for the quiet signal, multi-year offtake agreements. Because those contracts are where the future gets priced in. Let's connect this back to price action, because it'll help keep your thinking sharp. When you see a big drop after positive news, it's usually one of 2 things. Either the trade was overcrowded and needed to reset, or the market sees something deeper, like a backroom clause, a risk, or a shift that hasn't made the headlines yet. So don't jump to conclusions. Observe. If silver and copper hold steady post-drop, that's a sign. If they bleed lower with no bounce, that's a sign. If they rally weakly on no volume, that's a sign. If they rebound with real participation, that's a sign too. This is why I write in tight bursts, because markets speak in fragments. Here's something that'll save you stress. Don't treat miners like lottery tickets. If you're going to invest in them, treat it like a business analysis. Look at deposits, political risk, licensing, debt health, and how they raise cash without blowing up shareholders. Because when policy cash floods in, the strong names get stronger and the weak ones just get louder. And noise doesn't pay you. Execution does. If you want, I can break down a mining due diligence checklist in another video. No hype, just filters. If that's helpful, comment miner's checklist. And here's a real question for you. No agenda. Do you see price floors as strength or proof that the free market era is fading? Let me know, because this isn't just about minerals, it's about worldview. Okay, back to the big picture. So what did traders actually do? Exactly what they always do when a major structural shift slams into a hypersensitive market. They overreacted, then they fought. We got huge swings, fast drops, sharp rebounds. People called the top, called the bottom, then insulted each other, all before lunch. Silver crashed, bounced, and slipped again. Copper caught heat. Oil reacted. Bond yields twitched. Stocks stayed in their own world, as usual, until metals forced them to care. And if you're wondering why bullish headlines sometimes lead to hard selling, it's all about positions. When too many traders are already leaning long, Good news becomes a reason to cash out, rebalance, or dump risk fast. The news can be bullish, but the chart can still look brutal. Just don't let the first candle fool you. That candle rarely tells the full story. The real clue is in what the market does after it breathes. Because this countdown isn't just about price, it's about leverage. And here's what most people miss. When a government sets a price floor, it's effectively deciding the lowest revenue foreign sellers can earn to access the local market. That changes trade flows. That attracts some supply and locks others out. That brings forward investments that used to need years. And here's the part people whisper but rarely say on the record. If a government can enforce a minimum price, it can also start building stockpiles. You can make the case for subsidizing local refining. You can make the case for expanding capacity. And you can make the case for stepping into the market temporarily to restore balance. But here's the catch. Temporary programs tend to stick around. So if you're asking, is this bullish for silver and copper? The answer is, it can be, but not in a way that feels bullish at first. Because in the early stages, you get turbulence. You get deal-making. You get headlines that sound like progress until they turn into traps. Let me show you how that trap works. Imagine a negotiated exchange. We'll open access to X if you open access to Y. The market loves that. It hears deal and starts bidding risk, selling fear, and breathing easy. But if the agreement involves trading core assets like rare earths for oil or metals for tech or material flow for defense alignment, it can quietly cap upside in one sector while detonating gains in another. That's why I say, don't just watch price, watch what's getting built underneath the price, because once that structure is in place, it controls how every dip and rally plays out. Now give me 2 seconds to make something clear. I'm not here to yell, buy now. I'm not here to hype the moon. I'm here to lay out the board, and the board is shifting. If the US government is truly committed to bringing critical supply chains home, 2 outcomes are basically locked in. First, you'll get guaranteed higher pricing in parts of the chain, because long-term investment needs stable returns. Second, capital will flow toward the players that can actually produce, not the noisiest stocks, not the flashiest slideshows, the companies with permits, physical reserves, and real development paths. That's where opportunity and risk collide, because most people hear silver and think of coins or bars. But when governments say silver and copper, they mean electrical systems, weapons tech, manufacturing inputs, grid expansion, whole different buyers, whole different timelines, whole different risk profiles. If you're sitting there thinking, okay, but what am I supposed to do with this? Stick around. We'll talk in a minute about how this split could play out between physical metal and mining stocks, and why the real upside might be hiding in the tools, not the metal. Quick plug before we go further. If you want to hear silver wins from real people, not just analysis, there's a second channel linked in the description. Subscribe there for short hits of motivation when the market tries to shake your conviction. All right, back to the countdown. What's the government really trying to prevent? They're trying to avoid depending on a small number of foreign bottlenecks. The true choke point isn't raw material, it's processing. The question isn't just, do we have the ore? It's, can we turn it into usable industrial input, reliably, domestically, and at scale? And when a government probe calls that gap a security threat, you're no longer talking trade. You've entered national strategy. And national strategy doesn't care what Wall Street thinks. It rewrites the rules. This is why price floors matter. If the US and its partners agree to enforce a floor, it does 2 things at once. It blocks ultra-cheap competition that discourages domestic growth, and it gives miners confidence that new projects won't get killed by a price collapse. That's the sales pitch. That's how this will be messaged. But here's what it means in practice. The state is now actively shaping price. And when the state touches price, one uncomfortable question comes up. Who benefits? Because a floor doesn't help everyone equally. It favors those who are compliant, aligned, and seen as strategic partners. Others might still sell, but maybe not here, or not at that price, or not without jumping through hoops. So even before the 180 days run out, countries and companies start maneuvering. Some rush to join, some drag their feet, some threaten to retaliate. Some float side offers, some try to fracture the alliance. And in the middle of that mess, the market is asking one thing: will this deal fall apart? Because if it does, the heavy tools come out. Import floors, Section 232 powers, and maybe a set of domino effects no one wants to admit publicly. That's why this story unfolds as a countdown, not a single trigger, but a chain of pressure points. And chains come with cliffhangers. So here's the first one. 180 days might not be the real deadline. The real trigger could be when big buyers decide they can't afford to wait, when manufacturers start murmuring, let's lock this in early, when procurement teams quietly agree it's cheaper to buy now than gamble on what policy does next. That's when private stockpiling begins, not by governments, by businesses trying to beat governments to the punch. And that's when price can start moving in ways the charts don't immediately justify. Now let's look at the tape, because what you saw wasn't noise. Silver plunged hard, then rebounded sharply. That usually signals two factions. One group is leveraged. They got blown out when the volatility spiked. The other group? High conviction. They stepped in when price hit a level they consider unjustified. Here's what makes this moment so interesting. If a price floor is even possible, then unfair levels get easier to define, because policy starts acting like a soft backstop, even before anything is official. And when the market sniffs that backstop coming, it starts adjusting before the law is signed. That's why you'll often see a crashing chart suddenly bounce, even while the media is still catching up. But be cautious. A bounce doesn't mean you're safe. Catching a falling knife still leaves you bleeding if you're early. In markets, round 2 can hit harder than the first. So what do you track? Watch how price reacts near critical levels after that initial bounce. If it slices through support, keeps dropping, and finishes weak, that means structure is still in control, and another leg down is likely. But if price dips, rebounds fast, and holds that level, that's stress accumulation. And that's often how major reversals begin. I know some of you love chart breakdowns, some of you hate them. So here's the simplified truth. The chart isn't the story, it's the scoreboard. The real story is policy, and the game plan just flipped. Earlier, I said the biggest upside might not be in metals, but in the miners. Let's look at that, without the hype. If policymakers want secure access, they need output. For output, they need investment. For investment, they need profit. For profit, they need predictable price. That's the chain reaction. So even the idea of a price floor is a signal. We might make your margins predictable, and that re-rates companies that were ignored before. Too early, too expensive, or too boring. But, and this matters, a lot of mining companies are smoke and mirrors. Some have actual deposits, some have just dreams, some hold permits, some have just polished pitch decks, some can build, some can only raise money. So the real opportunity isn't miners up, it's smart miners get wind in their sails. And that tailwind isn't just price, it's government support, new capital, preferred contracts, and political momentum. And when a company gets both a commodity tailwind and a policy tailwind, that's where you see compounding returns. But pick the wrong horse, you get dilution, delays, and excuses. So if you want a deeper dive on how to filter mining plays without hyping tickers, drop a comment and say, miner filters. I'll build a full walkthrough. Now 2 questions. Seriously, drop your thoughts. First, do you think this 180-day clock ends in calm compromise or chaos and restrictions? Second, if silver and copper are now strategic, do you think retail is early or already late? Comment below. I read more replies than you'd think. Now let's zoom out to the macro view. The dry grass waiting for a spark. We're in a world where every major government wants the same impossible combo, growth without pain. And the easiest shortcut? Weakening the currency and boosting industry. That's not a secret, it's policy. And when every country does it at the same time, you don't just get trade wars, you get industrial arms races. That's why critical materials are now battlegrounds. Not because they're shiny, but because they're leverage. Control the inputs, you influence the outputs. Control the outputs, you shape the economy. Control the economy, you hold the negotiating cards. So when the US drops a proclamation about metal imports, it's not paperwork. It's a chess move in a global resource war. Here's your second cliffhanger. If today they're talking price controls on minerals, what's next? Because once intervention becomes normalized in one industry, it's easier to spread it to others. And markets hate uncertainty until they figure out how to profit from it. That's why early movers win. Late movers get caught flat-footed. That's why I always say, follow the structure, not just the spot price. One more thing that throws people off. You might see oil falling on a day when war risk is up. You might see equities rise when policy looks scary. You might see gold fade while silver goes haywire. That doesn't mean the story is broken. It means positioning, liquidity, and overlapping trades are crashing into each other. Sometimes the clean narrative gets drowned in messy flows. So don't let one weird day erase the big picture, because here's the signal that matters. Governments are saying they will not accept foreign supply risk anymore. And once that message goes out, you don't put it back in the box. I said we'd touch on physical metal versus miners, so here's the real difference. Physical metal is about control. It's about no middleman. It's about owning something that doesn't depend on a CEO or quarterly earnings. Miners are the lever. They rise faster but fall harder, so which is better? Depends on your goal. Want security? Go physical. Want torque? Study the miners. Want both? Split the difference, but never confuse them. Because when the rules shift, physics can go scarce, while miners get attention. And political attention is strange. Sometimes it's cash support, sometimes it's compliance, sometimes it's headlines, sometimes it's handcuffs. So this isn't buy and forget. This is buy and stay alert. Now let's return to that 180-day timer, because this isn't just a deadline, it's a pressure mechanism. It tells the supply chain, make your move. It tells allies, pick your side. It tells miners, scale up. It tells buyers, stock up. And it tells traders, move first. That's why you're about to see storylines collide. One day you'll hear, price floor is incoming, buy the dip. The next, talks are progressing, no crisis after all. Then suddenly, negotiations broke down. Restrictions likely. And right after, unexpected deal might be close. Through it all, price action won't wait. It will punish anyone who hesitates. So here's how to stay centered. Ask yourself these 3 questions every week while the countdown runs. What policy action just happened? What did the major buyers do? And what happened after the first move in price? If you can answer those consistently, you'll stay ahead of the crowd reacting to noise. Also, quick heads up, by the time you're seeing this, a members-only video should already be available where I break down the most recent developments and go deeper than I can here. If you want the full breakdown, join the membership. It's also the best way to support this work and show me you're tuned in during the moments that matter. And yes, members will get more detailed updates as this situation unfolds. Since we're on the topic of support, let me say this clearly but respectfully. Now, back to the real story, because there's another layer under the surface. When you negotiate price floors with allies, you're also negotiating coordination. And coordination means joint enforcement. Joint enforcement means shared intelligence. And shared intelligence means governments are mapping each other's weak points. So while the public hears trade agreement, the private game is really about resource alignment. That escalates fast, because once one side feels boxed out, they start hunting for alternatives. New buyers, new supply chains, new trade routes. And in a world that's already strained, those supply routes can become flashpoints. So this isn't just an economic clock, it's a geopolitical one. Let's talk about why silver and copper keep showing up even when they're listed alongside a dozen other metals. Copper is the lifeblood of electrification. Grid expansion, EV scaling, server farms, modern factories, copper runs through all of it. Silver, it's the silent workhorse, essential in electronics, high-performance circuits, and also tied to monetary psychology. So when policy touches silver and copper, you get 2 demand engines at once, industrial utility and strategic security. That's why price volatility hits hard. Now let's clear up a misconception. People hear price floor and assume it means instant upside. But it's not that simple. There's timing risk. If the market thinks the floor is far off, it might sell now and buy later. If it thinks diplomacy will solve everything, it may fade the move and trigger shakeouts. If it expects strict enforcement, it might front-run the floor and overheat. So price floors don't bring certainty, they bring new possibilities, and that still shifts the game. If you're still with me, here's the moment that should snap you to attention. This isn't just about managing imports, it's about redefining the rules around processed materials. That word matters because the choke point isn't just digging up the metal. It's what happens after the mine, smelting, refining, converting to usable form. If the U.S. wants to lower dependency, it'll need more domestic and allied processing. That means CapEx. That means long-term contracts. That means guaranteed offtake. And that kind of structure can boost the value of specific players. If you're only watching spot prices, you're missing the current beneath the surface. Let me shift to mindset now, because strategy requires mental discipline. People love big swings, but long-term wealth usually comes from reading the sequence, not guessing the spike. If you can see the policy path forming, you don't need to predict the candle. You need to align with where the machine is going. And right now, the machine is moving toward strategic industrial planning. One quick favor, if you've had any success in metals, trading, investing, or business, share your story in the comments, not to flex, but to encourage. Your story might help someone stay grounded when emotions spike. So what happens next? In the near term, expect a steady flow of negotiation chatter, leaks, anonymous sources, endless commentary over whether price floors help or hurt. Exporting countries will lobby, importers will stress, and traders will use every rumor to spark movement. Behind all that noise, watch the quiet indicators, changes in procurement, reserve building, long-term contract signings. Those are the real confirmations. Now here's your third cliffhanger. Once the government starts talking about locking in supply chains, the next move often involves infrastructure funding. That funding doesn't just lift metal demand, it lifts construction, hiring, energy usage, and financing. So if you see headlines about rebuilding processing capacity, don't just watch silver and copper, watch the ripple effect. There will be surprise winners. Let's bring this all back to you, the individual. Why should you care? Because policy doesn't ask for permission. It creates gaps. And if you're not prepared, those gaps leave you stuck watching. If you are prepared, those gaps become launch pads. So the real takeaway here isn't buy everything. It's read the field. Have a map. Make a plan. In plain English, here's what just happened. A U.S. national security probe warned about over-reliance on foreign sources of processed minerals. The response? A presidential order. Begin talks to adjust the import system. That negotiation window is 180 days. The goal? Work with allies to set baseline prices, price floors. If talks fail, expect stronger trade actions like import restrictions and security-based market interventions. And yes, silver and copper are directly in the crosshairs. That's the event. And why am I focusing on it so much? Because this is a signal. Governments are ready to step into pricing for materials they deem vital. One last thing before we wrap. Answer this for me in the comments. If floor pricing becomes real policy, do you expect the result to be higher prices or tighter supply? Because honestly, it could go either way or both. And depending on the outcome, your strategy will need to shift. So tell me your take. And if you found this helpful, do one simple thing: subscribe. Join the WhatsApp channel, link in description for daily updates and voice notes. And don't forget to check the member video already posted. It's got the deep dive. I'll catch you in the next one.